This program was made possible by the Corporation for Public Broadcasting and by contributions to your PBS station from viewers like you. Thank you.
Coming up on Market to Market. Prior to the global recession, growing foreign demand drives milk prices to record highs and prompts dairy producers to expand their herds. But in 2009, the export market goes dry, and dairy prices fell well below the average cost of production. We'll examine the economic outlook for America's dairy industry on a special edition of Market to Market next.
Funding for Market to Market is provided by Pioneer Hybrid, working with growers to help put the right product in each field. Pioneer, science with service, delivering success. From Madison, Wisconsin, this is a special edition of Market to Market, the Rural Economic Summit.
Welcome to the Pyle Center on the campus of the University of Wisconsin. I'm Mark Pearson. We're going to depart from our usual format on Market to Market this week to examine the impact of the recession in rural America. This is the second of four special road editions we'll produce in four Midwestern states over the next few months. And at each Rural Economic Summit, we'll hear from experts in different sectors of the rural economy. Tonight, we're coming to you from the College of Agricultural and Life Sciences Economic Outlook Forum. We've assembled a distinguished panel to answer questions both from our live audience here in Madison and those that were submitted online. We'll get to our panel in just a moment, but we want you to know why we're devoting an entire episode to an examination of the rural economy. With most media coverage of the recession focused on Wall Street, little attention has been devoted to the downturn's impact on Main Street. And few sectors of the American economy have been affected by the global recession more adversely than the dairy industry. For the last 20 years, dairy producers have ridden an economic roller coaster of price volatility. Just in the past 5 years, dairy prices have shot to record highs in 2007 before falling dramatically amidst a global recession in 2009. According to Bob Kropp, an emeritus professor at the University of Wisconsin-Madison, overexpansion and falling demand sent the dairy industry into a tailspin.
The major factor was a loss in dairy exports. That's relatively new to the dairy industry because go back 4 or 5 years, exports were incidental. Our buyers with Asian markets, what have you, or Mexico even, our largest customer, exports all fell off. And it was like putting another 5 billion pounds of milk back on the domestic market that we had to clear, about a 3% increase in supply.
Collapsing export markets were the second jab of a 1-2 punch, administered first by rising dairy inputs. Previously cheap feed for dairy cattle gave producers a reliable input price, but uncertainty returned once skyrocketing grain prices ripped through the livestock sector. Looking into his crystal ball, Kropp sees the coming years as an opportunity for an economic rebound in the dairy industry, particularly in the Midwest.
But long term, I come back and simply say that the economy will recover. World exports are picking up. It's a bright industry for the upper Midwest. We'll come out of these tough times, and it takes some management skills at the farm level and some risk management skills, but it's a pretty good industry.
Dairy prices have rallied in recent months and currently are up about 50% from the 2009 low. Nevertheless, rural America has not entirely escaped the worst economic downturn since the Great Depression. Here to help us assess the impact and prepare for the future are some of the top experts in key sectors of the rural economy. Dave Opedal is an economist at the Federal Reserve Bank of Chicago. He directs the Chicago Fed's survey of agricultural banks on land values and credit conditions and publishes the results in the Ag Letter. Bill Bruns is president of the Wisconsin Farm Bureau Federation. He is also the general manager of Homeland Dairy, a family partnership consisting of 600 cows and 1,300 acres of cropland. And Bob Kropp, professor emeritus in the Department of Agriculture and Applied Economics here at the University of Wisconsin-Madison. As a dairy marketing and policy specialist, Bob provides a monthly dairy situation and outlook report. And gentlemen, we appreciate all of you joining us here for our second Rural Economic Summit. And let's start, Bob, with you and what you see ahead in this dairy cycle that we're in. Obviously, as you pointed out in the feature just a moment ago, we had a huge export market. I think the Dairy Export Council wrote that China had an increase of 20% in dairy imports between 2007 and 2008. And that seems like a big number, but you start looking at that one deeper, and that was all the milk produced here in America's dairyland, just that increase. So we had those kinds of opportunities facing us in one year, and then the next year, some consumer issues in China, and of course, global destabilization, and then all disappeared. Where does that leave us on the export front? What do you see ahead?
Well, it's actually picking up a fair amount the last couple of months. All the commodities, skim milk powder, cheese, dry whey products, and butter all had substantial increases. Part of it due to the better economy worldwide. The China economy is improving some, the Asian market others. They're back in buying, and China, the Asia market, was about our fourth largest customer. Mexico, our largest, they're coming back some and purchases a substantial increase in purchase of powdered milk this last month. So, and all world market prices are coming up as a result of that. And the supply of milk in the world market, Australia is not coming back we thought. They're going to be down production. New Zealand not up as much. They account for about 35% of the exports. European Union situation has changed. Their production's down. They stopped export subsidies. So world market price is improving. Demand's picking up a little bit. So we look for maybe, we exported probably about 7% of our milk supply in 2009, get back to maybe 9. We were up about almost 11 in 2008. So it's going to be a substantial factor in improving milk prices to farmers, the return in exports.
A lot of the focus has been on reduction of supply here in the U.S. We had the cooperatives working together, buying out 250,000 dairy cows. Certainly has an impact on the supply, but numbers in the Midwest actually went up. Wisconsin production actually was up in 2009.
Yeah, the Wisconsin actually since 2005 has been in an economic recovery in the dairy. We were declining from about 1980 down, and we came back just last year almost 3% in production. There's been a lot of modernization, expansion, but the fact is that we raised a good share of our feed and not buy it, and we got higher milk prices than the West. So the areas that bought their feed and lower prices had more financial stress than the upper Midwest where we raised their feed and stronger milk prices.
All right, I want to come back to volatility and those issues in the dairy sector with you coming up in just a moment. But let's talk about the health of Midwest dairy producers right now. Dave Opedal with the Federal Reserve Bank. You track what lenders are saying out there. What are they saying these days about not just the dairy sector, but the general farm sector in the upper Midwest and in your states?
The survey of agricultural bankers that we do and publish in the Ag Letter came out last in the third quarter for 2009. So I don't have anything covering through the end of the year, but certainly there was a deterioration in credit conditions in the first 3 quarters of 2009, and more loans were starting to have to be refinanced, and repayment rates were down a little bit. So definitely some additional stress based on the low prices for dairy and hogs as well. There was a little bit better situation for corn and soybean producers. But the cost of the feed then being lower helped dairy producers, so it's kind of interdependent there. But definitely it's harder to get a loan if you're struggling, obviously, but there were still funds available according to the bankers.
All right, plenty of liquidity out there then as far as credit's concerned for producers who do need to expand?
I think that those that are in a good position and, as was mentioned, are good at managing their operations, those are the ones that would be better at getting loans. And the issue, I guess, isn't so much the availability of credit at the rural banks, because they fared a lot better than the large national banks during the financial crisis.
Good point. All right, well, let's visit now with the dairyman himself, Bill Bruins. He's president of the Wisconsin Farm Bureau Federation, and he manages a good-sized dairy operation himself, a family operation. And Bill, tell us about the last 12 months. What have they been like on Homeland Dairy's operations?
Well, there was a good stretch of time in 2009 that I became really close with my banker, and I had to call him to check to see if I still had a pulse.
Right.
But we saw some tough times coming in 2008, and we actually had most of our milk priced before the calendar turned.
All right, and did you price it? Did you use the board, Class 3 milk futures? Did you forward cash contract? What do you do?
We hire a broker for 8 or 9 cents a hundredweight, and we go to bed and sleep at night.
That's about as simple of advice as you can get. Input costs were soaring, though. Corn prices were higher. You have a lot of your own production.
We do. We grow most of what we need to feed our cattle, and as Bob said, that's where Wisconsin and the Midwest have come out with a leg up in this current dairy crisis.
All right. Bill, you're a family operation, or do you have someone coming in that'll replace you at some point to keep Homeland Dairy going?
Well, we have a partnership, and our two sons are fully vested in the partnership. They still give me the title of general manager. They still let me talk, but they don't listen too much anymore.
Sure.
Yeah.
I understand. You're kind of counsel then to the whole operation.
That's right.
All right, but well, we're glad they made time to make it available here. All right, now put your other hat on. Put on your hat as president of the Wisconsin Farm Bureau Federation, and tell us from that grassroots organization what your outlook has been and how do you think we reacted in 2009? The government, the CWT, to the whole. We were looking at $9 mailbox milk price here this year.
We're a general commodity farm organization, and so we have more members than just dairy farmers, but dairy's still king in our organization, and we pulled our dairy committee together early on in the year to talk about what we can do for our producers short term to help them all survive. So we worked hard at that, and I think our members came through in really good shape for the most part. Balance sheets took a hit, obviously, but the mood at our state annual meeting was great, optimistic, as most of us are as farmers. Hope springs eternal.
Absolutely. Well, certainly dairy prices soared to record highs back in 2007, but as the recession deepened in rural America, producer prices fell off the cliff in 2009, as Bill alluded to. Dairy producers responded to weak demand by cutting their herds nationwide, but according to the USDA, dairy cow numbers declined 2.6% nationally from November of 2008, but not here in the Midwest. Their researchers found more cows were being milked than the year before, and here in Wisconsin, for instance, milk production actually rose 4.5% in 2009. An operation reflecting the growing trend is the Crave Brothers Dairy near Waterloo, Wisconsin. And as producer Art Hackett discovered, low prices haven't made life easier, but years of improvements at least made $9 milk survivable.
When the four Crave brothers began a major expansion of their farm about 7 years ago, their goal was building a better dairy farm.
And we thought this is an opportune time in our career to take the equity we've had and capitalize on that equity to develop a farmstead that is better than anything we've had in the past.
One of the first things the Crave brothers built was an on-farm cheese factory producing specialty European-style cheese, such as Le Frere and soft mozzarella. Then came bigger barns with room for larger framed cows. They partnered with an electrical contracting firm to build a digester to generate power from the methane bubbling from composting manure.
Now that was at a time when milk prices were pretty darn good.
Yeah, that's right. We knew they wouldn't be good forever. Nobody anticipated they'd fall right off the table like they did the last year, though. Oh, we bled for a while, not as bad as some folks. Yeah, it's been a really tough last year and a half.
But Charles Crave, who handles the business end of the farm operation, says the improvements have been paying off during the downturn.
Half or more of our milk is used in our cheese production. So being seasonal cheese, during the fresh mozzarella season, more of our milk is used.
And remember, the Craves, that's Charles' brother George scooping curd out of the vat, own the cheese factory, getting the added value of a finished product rather than selling milk as a bulk commodity. And the varieties of cheese the Craves produce compete with European imports, which are at a disadvantage because of a weak dollar. Then there are efficiencies built into the process.
We can take our milk stored in this milk silo out of this spigot and directly hook it to a pump, which pumps that milk directly underground to our cheese factory 100 yards away.
Another pipeline returns whey from the cheese plant to the farm. It's mixed into the feed for the cows. The material and the profits stay on the farm and in the family.
And I've told a lot of folks, if you make an investment 8, 9, 10 years ago, you'd like to see it starting to pay off after that length of time. And fortunately for us, the cheese factory has helped us through this last year.
The manure digesters are another project which adds value to the farm. They pull the methane from composting manure and use it to power a turbine, which generates electricity. Crave says he's not in it for the electricity, he's interested in what's left over. The composted residue from the process is used for bedding for the cows.
We have cows that have longer lives than a lot of herds, and a lot of it has to do with how comfortable they are. It's very warm in the winter. You know, if you're laying on sand for bedding, that wouldn't be so cozy, but the cows are laying in here, they're nice and comfy.
University researchers like to point to the Crave Brothers farm as an example of what can be done to make a farm more energy and economically efficient. But Crave says it takes a certain type of operation for the system to work.
One of the things we have is we have 4 partners. I've got a sister-in-law with 20 years experience in the milk marketing business. So to have those resources in-house is a tremendous asset. There's probably been as many of these ventures which have failed as which have succeeded in the last decade.
For Market to Market, I'm Art Hackett.
All right, we appreciate that. And happy to say Art Hackett is with us here at the University of Wisconsin here in the Pyle Center today. Appreciate that report from Art. We're producing this week's show, of course, on Wednesday in conjunction with the University of Wisconsin's Economic Outlook Forum. And so far during this very short week, grain prices continue to be under pressure from record crops revealed in last week's USDA annual production summary. And as of Wednesday's close, March wheat was down more than 12 cents, while the nearby corn contract moved nearly a nickel lower. The Agriculture Department also pegged 2009 soybean production in record territory, and with a large crop in South America all but assured, prices retreated again this week. As of Wednesday's close, March soybeans finished nearly 25 cents lower, while the nearby meal contract was down $5.50 per ton. Of course, producers and representatives here in the dairy sector are keenly aware of the sustained rally occurring in their commodity, and this week was no exception as nearby Class 3 milk futures rose 10 cents, while the deferred contract was up 15. And of course, a break in feed costs is a welcome development in the livestock sector, where February cattle futures, let's talk about cattle futures first, they were down 25 cents. Feeders were up $1.23. Good news for those bull calves. The February lean hog contract was up 48 cents. Last week's USDA production summary caught a lot of the trade off guard, but it was a welcome reprieve in the livestock, poultry, and dairy producer community. Bob Kropp, to what extent, as you look at the dairy industry right now, we talked about Class 3 milk futures and their move. It seems like for much of my lifetime, we had milk prices were simple. We had the federal milk marketing orders. We had ground zero in Eau Claire, Wisconsin. And now, literally in the last, since 1990, it's been feast or famine in the dairy sector price-wise.
Well, the big thing of that is a change in the dairy price support program that kicked in 1950. We supported the price at a percent of parity. And in fact, in the 70s, we practically doubled the support price, resulted in expanded production and surpluses. And in 1981, made a major change in dairy policy. Went off of that, where Congress set the support price based on government expenditures and costs. But this way, the support price was $13.10 in 1981. Today, it's about $9.30. So really, market forces drive prices today. There's problems with federal orders, no question about it, but the volatility and change we've seen is greatly due to a price support program that really has no impact anymore, as far as I'm concerned. In fact, it may actually hinder some things that's going on. So,
you don't expect the volatility to change?
I don't see that change. Dairy is a very sensitive market. I mean, it's a perishable product. There's a fine line between too much and too little. It depends upon, domestic demand, international markets, and doesn't take big changes, a big change in prices. The Secretary of Agriculture, Bisec's got a committee that's supposed to look at, volatility, et cetera. Maybe they'll come up with something. The 2012 Farm Bill may introduce some things, but really it's pretty difficult unless we have drastic change in policy, which I don't think we're going to go that route, something like a Canadian program or something. So it's going to be there. So dairy farmers need to learn how to manage the price risk, and there's tools to do it. And so there's a lot of talk about maybe that's the way we need to move is make the price risk management tools more user-friendly in that and have farmers to manage some of this price risk. Because it's not all bad, as Bill pointed out. He fared fairly well. With volatility, there's opportunities for better prices too. So I think they may look more at some of that. come back to Fed orders, I think everybody's pretty unhappy with some things. We may see some pricing structures that may change things a little bit, but I think price risk management is pretty important.
As you look at this thing, Bob, going forward, we mentioned the $250,000 head buyout in the CWT buyout for 2009. It had a little bit of an impact on the beef market. Hamburger demand has been phenomenal, so really not a whole lot. Do you see another buyout as we go into 2010, or do you think we're in balance at this point?
Well, they might. I don't know. I mean, National Milk, I think, reevaluating that whole program. The good part about that is that cow slaughter last year was up something like 12%, but beef slaughter was down, and so the total amount was not a big impact at market. They're evaluating their whole CWT program. They're trying to make it more effective. You only got about 65% of the milk participating, financing that program. So whether they have another one or not, I don't know. But I think you're going to see cow numbers continue to decline with or without that this year, with some exiting and the financial stress a little bit in 2010.
And still be more regionalized, maybe more production being put on here in the Midwest, particularly in areas like Wisconsin.
Yeah, we do not see a major exiting here. It might be, some increase in that, but there's the financial stress and greatly all the westerns. Every one of them is down. Even Texas now was growing. Now we see cow numbers drop about 4% there. And it's going to take a while before, with that equity loss, for you see any major expansion. There'll be some. California probably increased production this year, but not come back where they were.
All right. Well, we'll be interested to see what happens. Now, Dave Oppenall, from your standpoint, look at what the Federal Reserve is thinking. And I read your ag letter. You're talking about maybe some increased liquidations and so forth. Your feel for the dairy sector going forward for 2010?
It's certainly going to be better than it was last year. There's, with milk prices higher, that's going to give better cash flow, and the operations are going to be able to start maybe to recapitalize a little bit. I guess in our surveys, the stress on dairy can be seen in higher numbers of loans that are in trouble, and there may be some liquidations out of that, but as we've already heard, that seems the worst is past. And it's more a manner of managing through the implications of what's the loans that are there, and those that have higher debt to cow ratios are going to have more challenging time ahead of them than those that stayed lower in that area.
All right. Well, of course, that's always critical for an operation in the livestock sector, anywhere in agriculture, where we tend to look at traditionally narrower margins, but farmland values have been phenomenal. I mean, they've shot up dramatically. We saw a pullback in 2009. What are your lenders telling you about farmland values?
The values have been down last year, and USDA's numbers showed that as well. And it looks like, based on what the lenders were saying, that there was kind of a mixed market in the last part of this year. There were down quarters for the first part of the year, and then the third quarter was up a little bit from the prior quarter, but still below a year ago. So there's hot spots out there where the high quality land is still bringing a pretty high value, but at the same time there's other ground that's not maintaining its value, and so it's really very mixed, especially when you think about in Wisconsin, the recreational land has been soft because of the overall economy as well. So there are a number of things that are going to hold land values from rising very much.
All right. Bill Bruns, bring it home as a producer in your operation. Tell us what kind of an impact. Are you looking for land to buy? Is there much land movement in your area?
There are pockets in Wisconsin where land values have really gone up a lot, and rent rates have followed suit. So, dairy farmers need a land base to get rid of their nutrients from the cattle. So if you have that land base secure, you're in pretty good shape. But so that's going to be somewhat of a limiting factor. But I think for the most part, the dairy industry in Wisconsin is in pretty good shape with a land base.
All right, so you don't see much expansion there. And as far as utilizing tools, you mentioned you hire a broker, 8 to 10 cents, 100. What a deal! It's a great way to control risk and take advantage of volatility.
Well, I oversimplified a little bit.
Of course.
We try really hard to maximize our efficiency on the farm, to increase production per cow. Even though our cows, we're told, are worth $700 less today than they were a year ago. We still treat them the same. We still try to feed them as good as we can to get as much milk as we can. Even though the land values have declined somewhat, we're still going to massage everything we can out of that acre of ground.
Absolutely. On the input side, on the crop input side, costs are coming down a little bit there. So we got a break on the corn price and hopefully a break on the inputs for you.
On fertilizer costs, we're seeing quite a substantial break from a year ago. Fuel prices are going to be maybe up slightly from a year ago, but overall, our cost of doing business is going to be improving this year.
All right. We've got 1 minute. Bob Kropp, kind of wrap things up for us. 2009, a tough year with some severe lows. As you noted, a 50% improvement by year end. Look for better times ahead for 2010?
Yes, I think a continual strengthening. You've even mentioned the futures where it was. If you take the average of that, they got a base price of about $15.45. We were $13.07 last year. I'm about the same ballpark. And by the end of the year, start out with maybe high 14s on base price, 15 something on all milk price. End of the year, high 16s and get up to the 17, 18. But it's like I said here, it's going to take a couple of years of good prices to build back some of the lost equity. You're not going to do it in 1 year.
Absolutely. But we've had great managers in the state of Wisconsin, great support from the University of Wisconsin. I want to thank you, Bob, very much, and Dave, appreciate it. Bill, appreciate your insights as a producer. But that's going to wrap up our special Rural Economic Summit. And again, we want to say big thanks to our panelists, and let's give a big thanks to our live audience here at the Pyle Center at the University of Wisconsin-Madison. And we want to remind you that we'll produce 2 more of these special road editions of Market to Market in the months ahead. Future programs tentatively slated at Nebraska and Kansas. And of course, you're invited to join the discussion by submitting your questions at the Market to Market website. We'll also be posting new material on the Market to Market blog. And of course, you're invited to share your insight there as well. And be sure to join us again next week when we'll return to our regular format. So until then, thanks for watching. I'm Mark Pearson. Drink more milk and have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by Pioneer Hybrid, working with growers to help put the right product in each field. Pioneer, science with service, delivering success.
This program was made possible by the Corporation for Public Broadcasting and by contributions to your PBS station from viewers like you. Thank you.